Welcome to the fascinating world of restaurant commissary economics, a game changing strategy transforming how modern restaurant groups manage costs and scale. With off premises dining exploding and labor costs skyrocketing, consolidating production into a centralized kitchen isn't just smart, it's often essential for survival. Today, we're diving into cutting edge research that reveals how smart operators are slashing costs and boosting efficiency through strategic commissary implementation. This isn't just about making food in bulk, it's about reimagining your entire financial engine. Let's explore when a commissary makes sense and discover the two game changing accounting methods that separate struggling chains from industry leaders. So here's the question keeping restaurant entrepreneurs awake at night. Should you consolidate your expensive kitchen equipment into one powerful facility? The research shows this decision hinges on a few critical factors. When you have signature items like fresh bread, pasta, and sauces that benefit from high volume production, a commissary becomes a no brainer. The stakes get even higher when you're paying premium rent for prime storefronts. Why waste valuable real estate on large kitchens when you could be maximizing dining space for paying customers? If off-premises demand is crushing your capacity or labor shortages are hurting consistency, the commissary is your cost-consolidating machine. Here's where most restaurant groups hit a wall. Traditional models fail because they ignore the principle that managing multiple locations requires centralized thinking, not replicated tiny operations. But even when operators recognize the benefits, they hit a massive execution barrier: the accounting. Operationally, it's tempting to just transfer the food, but financially, that mindset breaks your reporting. One store's food cost can look wildly inflated, while the commissary looks like a permanent money pit, simply because the costs are sitting in the wrong place. The gap isn't whether commissaries work, it's how to account for them, so decisions are based on truth, not accounting artifacts. This is where the breakthrough happens. Research identifies a clear decision framework where a standalone commissary can make financial sense with as few as 3 stores. To manage this properly, we use two powerful accounting lenses. Method 1, the separate entity approach, where the commissary acts like an external vendor, selling products to your stores at a price that covers labor, materials, and overhead. Method 2, the pass-through model, where the commissary itemizes costs, food stays food, labor stays labor, and passes them directly to the stores. Both methods ensure the commissary breaks even while providing the visibility you need to actually manage your business. Let's look at what the P&Ls reveal. In the separate entity method, the entire commissary invoice appears as a cost of goods sold at the store level. It's clean and simple, but it hides the detail. Your store's food cost line now silently includes commissary labor and rent. Compare this to the pass-through method. The net profit remains identical, but the store's P&L becomes diagnostic. You can see exactly what portion of your prime cost is truly ingredients versus production labor. The breakthrough? You aren't changing reality. You're changing visibility. And visibility changes the decisions you make about pricing and staffing. What happens when your commissary generates its own revenue through wholesale, catering, or its own storefront? This is the toughest case because labor and overhead are shared across different channels. The research reveals two powerful techniques. The gross-up method, where you add labor and overhead percentages to each internal invoice, and the weekly true-up, where you allocate actual costs at the end of the week based on the percentage of goods transferred to each store. These solutions ensure your intercompany pricing accurately reflects the true burden of production, while your commissary maintains break-even status across all channels. We are witnessing a fundamental shift in how restaurant groups think. The old paradigm was about replicating self-contained units over and over. Success in the new paradigm means thinking of your group as a production network. The commissary isn't just a cost saver, it's a strategic asset for quality control and innovation. It allows you to develop a new item once and distribute it everywhere simultaneously. With modern cloud-based systems replacing manual spreadsheets, the data infrastructure has finally caught up to the operational needs. The future isn't about building bigger individual restaurants. It's about building smarter, networked production hubs. Let's bring it all together. Commissaries are powerhouses that become viable at as few as 3 locations with high menu overlap or occupancy costs. Remember, choose the separate entity method for wholesale or finished products and the pass-through method for internal-only visibility. Don't wait until you have 10 stores to fix your inefficiencies. Start by analyzing your current kitchen costs, evaluate your menu overlap, and consider an incubation kitchen to test the model. When your production flow and your cost flow match, your reports become tools for growth rather than sources of confusion. Connect with Forks for the experienced accounting professionals your restaurant needs. Details in description below.